Today's topic is impairment loss on trade receivable. As you move with accounting, you will hear the term impairment loss quite often. Next time you will hear terms like impairment loss on inventory or impairment loss on non-current assets. So let's understand what impairment loss means before we start today's topic. The term impairment loss indicates that an asset has lost its value. In other words, impairment loss on trade receivable means the trade receivables has lost its value. Why will the trade receivables lose its value? Most business-to-business sales are conducted on a credit basis. The goods are transferred first, but payment is made at a later date. Now the question is there any risk or danger associated with selling on credit? This is quite an intuitive question, don't think too much. If you still don't get what I mean, consider this. A stranger approaches you and requests you to lend him $100,000. This person is unemployed, he is a bankrupt, and he is a gambler. Will you lend him the money? Why or why not? I believe it is quite clear now. Most of you will not lend him money for fear that he will not return you the money subsequently. In business, we call this a credit risk. The risk that your customer will default payment if you sell them on credit. When they do not pay you subsequently, the trade receivables become worthless and is no more an asset since you cannot collect money from the customer. The trade receivables yield no economic benefits anymore. The most common reason for a customer to default payment is due to liquidation, winding up, or simply put, the customer closes its business. When that happens, you cannot collect money from the customer because the customer's business do not exist anymore. It is equivalent to claiming money from a deceased person. The journal entry to record estimated uncollectible debts for the year is to debit impairment loss on trade receivables and credit allowance for impairment of trade receivables. Here, I have introduced you to two new account names. Impairment loss on trade receivables is an expense. It reflects the loss of value in the trade receivables because the debt cannot be collected. We will aggregate it as a selling and distribution expense in the income statement. Allowance for impairment of trade receivables is a contra asset. It decreases the value of an asset, trade receivables in this case. This part may be quite confusing, so let me make myself very clear. The purpose of entering this journal entry is to change the value of the allowance for impairment of trade receivable to the amount of trade receivables expected to be uncollectible as at year end. This journal entry is entered only on the last day of the financial period or month. The company may not receive any news about its customer closing business, but at the end of each financial period, it needs to adjust the allowance for impairment of trade receivables to show how much trade receivables the company thinks it cannot collect. A good way to estimate uncollectible debts is to prepare a trade receivables aging report, which shows how old each debt is. Specifically, it measures the time from the day the sales was made until the last day of the financial period. The company can then investigate the old debts to find out if the customer is showing signs of closing business, like facing lawsuits for defaulting on loans or experiencing any financial difficulties. This is how a trade receivables aging report may look like. Here, you can see that the debts are classified according to how old it is. From here, you can spot quickly if there is any long outstanding debts. In this case, customer 0003 and 0006 has owed the company for more than 90 days. The company can then investigate these two customers to find out if they are facing any financial difficulties or if they are facing lawsuits for defaulting payments before making a judgment as to whether these two debts are collectible. I understand that you are probably still confused with the journal entry I introduced earlier on. So let me illustrate what I mean when I say the journal entry is entered to change the allowance for impairment of trade receivables account balance to the amount of trade receivable the company thinks is uncollectible. Assume this is a new company, and on the last day of the first year, it prepared the trade receivables aging report and thinks that $400 of trade receivables will default payment. The journal entry to enter is debit impairment loss on trade receivables and credit allowance for impairment of trade receivables by $400. Now, the allowance for impairment of trade receivable balance become $400. At the end of the second year, the company estimated $1,000 of trade receivables that may be uncollectible. As usual, you need to debit impairment loss on trade receivables and credit allowance for impairment of trade receivables. But by how much? Is it $1,000? Wrong. The correct amount is $600. Remember, we want to adjust the ending balance of the allowance for impairment of trade receivables to the amount expected to be uncollectible. At the end of the second year, $1,000 is expected to be uncollectible. The starting balance is $400, so we will increase the amount by $600 to make the ending balance $1,000. Now, what if the potential uncollectible debts decrease? Let's say at the end of the third year, the company thinks $500 is uncollectible. Now, we have to decrease the allowance for impairment of trade receivables balance. And to do that, we will enter the reverse journal entry. We will debit allowance for impairment of trade receivables and credit impairment loss on trade receivables by $500 so that the ending balance becomes $500. When we credit impairment loss on trade receivables, it represents an income for the company. So far, I have been telling you about potential uncollectible debts, meaning it has not happened yet. What if it is made known that the debt is indeed uncollectible? So what if the customer liquidated its business? In this case, we will enter a different journal entry, debit impairment loss on trade receivables and credit not allowance for impairment of trade receivables, but trade receivables. If the debt becomes impossible to be collected, we will directly decrease the trade receivable account instead of putting it into the allowance for impairment of trade receivables. I understand that you may be confused as to when you should enter which of the two journal entries. So before I end off, let me summarize the difference between the two journal entries. If the company thinks a debt is potentially uncollectible, it will debit impairment loss on trade receivables and credit allowance for impairment of trade receivables. This journal entry is entered only at the end of the financial period or month, and it adjusts the ending balance of the allowance for impairment of trade receivables account to the amount that the company thinks is uncollectible as at the end of the financial period or month. If the company receives news that the debt is impossible to be collected, it will debit impairment loss on trade receivables and credit trade receivables. This journal entry is entered when the company receives the news that the customer has liquidated, wound up, or closed business. It is not an adjustment for the end of the financial period, so it can be entered at any time of the financial period. The journal entry directly reduces the value of the trade receivables.